Hello again, traders. Doing trade once again from DRFX, Swing Trading Mentoring. Going to be taking a quick look at some trades that were made by myself and my subscribers as part of the new aggressive trading methodology that began on December 18th last year. Now, as you will see described on my website, this new approach targets trading gains of between 50 pips and 70 pips within 24 hours, and where possible and justified, we'd also target trading gains of between 30 pips and 50 pips within 24 hours, as well as trading gains of between 70 pips and 100 pips within a 48-hour holding period. Now, since this methodology began on December 18th last year, it has produced a rate of return of 18.1% on my live account within just 6 weeks. All of this also coming from just 8 trading opportunities. So what this is showing you is that once you're able to target the best trading opportunities on the larger time frames that have the best chance of success, large rates of returns are possible in the currency market within a very short period of time. Also going to be taking a look back at a trade that was made in January of 2015, where we had captured a trading gain of 231 pips on the New Zealand Swiss franc, just ahead of the sharp reversal that took place on this currency pair as a result of the actions taken by the Swiss National Bank. So what this video is going to be showing you is that whether you're trading within normal market conditions or abnormal market conditions, once you're able to use the accurate trading tools of Japanese candlestick signals, trend lines, and consolidation patterns on the larger time frames, and you use them in conjunction with these 8 key steps to identify market direction and trading opportunities, you'll be better able to maximize on the trading gains provided by the currency market ahead of sharp reversals, so that you can remain profitable and successful over the long term in this $1 trillion market. Now, first up is this trade that was done recently on the New Zealand Canadian dollar, which provided us with a trading gain of 50 pips and a rate of return of 1.86% on my live account. Now, what we did here on the 4-hour chart of this currency pair was to trade this bull crown setup that created this transition from the downtrend to the uptrend, which was taking place within the context of the formation of a consolidation setup on this time frame. So as you can see here, the market had already formed the support boundary and was in the process of completing the formation of the resistance boundary. And so what it did was to provide us with this bull crown setup with this left tip, center tip, and right tip that started to break above the downtrend line to start the uptrend. And so when the market presented us with this bull candle, we simply enter the market at the close of this candle, placing our stop loss below this uptrend line, and then capturing a trading gain of 50 pips just before the market started to slow down ahead of reaching this resistance point. Next up was a trade that was done on the Australian US dollar, which gave us 70 pips and a rate of return of 3.82% on my live account. This took place on the daily chart of this currency pair, where the market had created this false consolidation breaker reversal that provided this strong downtrend in favor of the US dollar. So you can see here that the market had formed this pennant consolidation setup. It initially started to break up bullish, but this was short-lived as the market reversed sharply, taking us back inside of the consolidation and back to support, and eventually continuing the bearish momentum to create this downtrend line and this downtrend that provided us with this trading opportunity. So what we did was to enter the market using this bearish engulfing candlestick formation, entering the market at the close of the candle at 5 p.m. Eastern Standard Time, placing our stop loss comfortably above this downtrend line, and then capturing a trading gain of 70 pips over 2 days, just before the market started to slow down and move sideways. Next up was this trade done on the Canadian and Japanese yen. This gave us a rate of return of 4.98% on my live account, as we captured a trading gain of 50 pips. Now, this took place on a 4-hour chart of this currency pair, where the market started to transition from an uptrend to a downtrend, taking the form of a bear count setup that led to the break of this uptrend line and providing us with this trading opportunity as the market transitioned from this downtrend to the uptrend, from this uptrend to this downtrend in favor of the Japanese yen. So what we did here was to enter at the right tip of this bear count formation, left tip, center tip, right tip. Market gave us this bearish engulfing candlestick formation that created this right tip. Entry took place at the close of this bear candle here, with the stop loss placed comfortably above the high of the formation. And then we targeted a trading gain of 50 pips, just ahead of the expected slowdown that was expected to take place at this support point. Next up was this trade done on the Euro Pound, where we captured a trading gain of 38 pips, which represented a rate of return of 2.53% on my live account. This one took place on a forward chart where the market had formed this consolidation setup. And what we traded here was this false consolidation breakout reversal, where the market had initially attempted to start a bullish breakout, but this was taken out by this strong bearish reversal that created this U-turn evening star formation. Entry then took place at the close of this candle, with the stop loss placed comfortably at an area on the 1 hour chart. And then, as you can see here, the market continued the bearish momentum and eventually returned to support and providing us with a trading gain of 38 pips. Now, let's take a look back at the trade that was done on the New Zealand Swiss franc in January of 2015. What we did here was identify this consolidation breakout setup, where the market was breaking out above the resistance boundary with these bull candles. And what we did here was to target a trading gain of 200 pips, which was going to coincide with a major resistance point. And as you can see here, what the market did was to actually spike a little bit and actually provide us with an extra trading gain of 31 pips. So perhaps this was an omen, a sign as to what was about to come and the volatility that was about to take place in the market. But as you can see here, the market spiked and provided us with this quick trading gain, with this trading gain of 231 pips. It eventually pulled back and then continued bullish. But this was the area that we were always expected to pull out from, because this was the area where we had identified a major resistance point, which is where the market generally has a tendency to pull back after these types of consolidation breakouts. And then what you can see a few days later is that the market reversed sharply due to the actions that were taken by the Central Bank of Switzerland. So as you would recall, the market reacted this way, or what took place was that the Swiss franc gained suddenly, simply because the central bank removed the exchange rate peg that had existed between the euro and the Swiss franc. So this type of reversal took place across all the Swiss franc related pairs. And as you can see here, this would have resulted in a large trading loss. And, well, more specifically, it would have resulted in a liquidation of my trading account had myself and my subscribers held on to the trade for longer than we actually did. Unfortunately, however, this actually led to the liquidation of many trading accounts across the world. But the point of this is to show that whether you're trading in normal market conditions or abnormal market conditions, once you're able to identify where the market is likely to be pulling back, you will in most cases be able to avoid the reversals that take place at these areas during normal market conditions as well as abnormal market conditions caused by flash crashes as well as central bank intervention. Because what I've noticed over the years is that these types of major actions taken by the central bank as well as flash crashes generally take place at these major pullback points. So since these major pullback points are better identified or easily identified on the larger time frames, the advantage that you have with trading on a daily chart and a 4 hour chart is that you're able to spot these barriers very early and make your decisions in terms of your take profit so that you're not caught out by these large reversals that take place from time to time. So I will put a link in the description of this video to this trade that was made. You will see a description of that trade in detail on my trading blog, where we captured that trading gain of 231 pips just ahead of this sharp reversal. So whether you're trading in normal market conditions or abnormal market conditions, The important thing to do is to ensure that you're able to draw the market setups accurately to precisely identify what is taking place in the currency market on the daily chart and the 4-hour chart. And then once you identify what is taking place, you then have to identify whether or not the signals that are being provided are strong enough that would allow you to take advantage of what is taking place. Of course, no trade is complete without a strong stop loss. And to ensure that you're able to stay in the trade until the trading target has been hit, it is very important that we also identify the best areas to place our stop loss, which is either going to be on the 4-hour chart or the 1-hour chart, which provide the best opportunities to place our stop loss at a strong area that will withstand temporary pullbacks until our trading target has been hit. Of course, it's very important that when we're trading within the context of consolidation setups, we identify accurately the boundaries of resistance and support, and we also need to know when the market is likely to pull back just before actually hitting the support or resistance point, or whether it is likely to actually hit those points. So it's very important to make a determination, a distinction in terms of the market scenarios that allow you to make the decision. In other words, you need to know the market setups and the market signals that tell us when the market is likely to hit the resistance or support point, or whether it's going to pull back without actually hitting those points. So that's going to be very important in terms of our trading target and our take profit decisions. Of course, very important that we establish the number of pips that we want to capture for our trading opportunity. If a trading opportunity is only going to provide us with a trading gain of 50 pips, it makes no sense to try to capture a trading gain of 100 pips. So we have to ensure that we're able to accurately identify the number of pips that the market is going to be providing for us in a particular trading scenario, and that we also establish a holding period, a maximum holding period, that will allow us to capture those trading gains and exit the market before the market reverses. So that's it in terms of some of the trades that have been traded over the last couple of weeks on my live account as part of the new trading methodology that began on December 18th. This is a more aggressive approach compared to the one that we were using before. And as you can see, very large rates of returns are possible in the currency market within a very short period of time, so long as we focus on the best trading opportunities that are provided by the daily chart and the 4-hour chart, and as long as we're able to identify what is taking place and establish accurately our trading targets, and that we're able to exit the market just ahead of sharp reversals so that we can remain profitable over the long term. So until next time, traders, happy trading.